There we go. I have a voice. Next, what are we going to be doing? That is the big question. Did you guys enjoy that chat, by the way? You finding this very valuable? Okay, great. Take this home. Obviously, a lot learned yesterday as well. We apply those to those businesses, and hopefully you'll be one of the speakers on stage within the next couple of years. I want to see you deliver keynote addresses. Right? Maybe you, man. No, maybe not, but maybe one day. Now, moving on, we've spoken about philanthropy in tech. Next, we're going to be chatting. Oh, sorry, I got myself confused there. Our keynote speaker. We're not going to be having another panel. We're doing a keynote speaker now. Now, our keynote speaker is Yoram Wijngaarde, founder of Dealroom.co, or .co as some people call it. And essentially, it's a platform that helps new investors and tech companies connect with each other and share data, which is so important. If you don't share data, you don't have access to the data, you can't really make those decisions. The future of investing certainly has the fund, we can ask that question, has the fundraising system changed? So please, without further ado, our guest. Please put your hands together.
Yeah, thank you for that introduction. So, my name is Yoram Wijngaarde. I'm from the Netherlands. I was asked to speak here about the future of capital raising. So I think this is a subject that's close to everyone's heart, at least people in this room. I call it capital raising, not fundraising, because our previous topic was charity, which is a very important subject, and to me fundraising sounds too much like charity. Here we're really talking about capital, we're talking about capitalism. I'm going to talk about how to allocate capital to its best possible use, where to invest, and as a startup, how to get funded. So I'm going to talk about all the latest developments about crowdfunding, micro VCs, the introduction of software into venture capital and how that impacts you as a startup. Angel lists, you've heard about syndication. I'm going to talk about all of that in the next kind of 20, 25 minutes. But before doing so, I want to take a step back, go to the kind of the bigger picture of everything. This is a big topic, so I might, bear with me. So let us start with what I call corporate finance. Can you see it? I need to go here. Yes. Corporate Finance 1.0. I don't know if anyone here knows this guy. This is one of the most famous bankers. His name is John Pierpont Morgan. I was a banker myself for 10 years, so that's why I know these things. He was the founder of JP Morgan. He was one of the world's most powerful bankers in the late 1800s and early 1900s. And he was kind of, I show him as a symbol, for Finance 1.0. He was like a super banker. He was super powerful, connections everywhere, politically connected in the business world. He started to make his fortune in the American Civil War. And once he became powerful, he even helped governments finance wars. He helped governments finance World War I. When World War I was over, for example, the government of France gave him one of Napoleon's palaces to thank him. That's how powerful bankers were in that time. He himself, by the way, avoided to serve in the Civil War, in the American Civil War, by paying a substitute $300 to go in his place. So I guess some things, they never change. And I don't know what happened to the substitute. One last fun fact on JP Morgan, he also invested in the Titanic. Anyway, he's one of my favorite bankers because he has some very funny quotes attributed to him, and this is my personal favorite. A man generally has two reasons for doing one thing, and that's one reason that sounds good and the actual reason. And I think that's a great quote, and it happens a lot. It's very applicable to finance. For example, if someone asks, why are you raising money? Or why are you selling your company? People always give a reason that sounds good. Try to avoid the real reason. So that's Finance 1.0, it wasn't all about JP Morgan. There were a couple of power bankers. And that type of relationship-based banking, very much about personal relationships, that ended in the 1980s. What happened in the 1980s is it was kind of a new era of corporate finance. It had something to do with deregulation. So because of deregulation, it enabled the creation of mega banks that you see today, like Citigroup, Morgan Stanley, Goldman Sachs. They became huge institutions. That was possible because of deregulation. And also there was financial innovation. It wasn't so much like a technical innovation, but in universities, people started to learn about how to price options, and they applied these theories in practice, and that's how the first hedge funds started. And also one of the first hedge funds was a company called Long-Term Capital Management. I don't know if you heard about it, but they basically single-handedly crashed the whole world stock market in 1987. So, everything that's happening now already happened also 20 years ago. So we're now in Finance 2.0, and it was not anymore about personal relationships, it was about balance sheets. Banks just threw their balance sheet at everything. They lent capital to companies in order to get favors in return. It became super complicated. People saw the stock exchanges, they saw there a lot of computers being used, so everything looked hyper efficient. And the financial markets, everyone thought they were hyper efficient, but actually through the back door, banks were skimming off a lot of money without anyone knowing. They were supposedly taking risks, but then offloading those risks to taxpayers and other people who had no idea, and they made a lot of money, as everyone now knows. So, there was also some excess. And I think, in summary, the big problem is we tried to give an important role to experts, like, okay, how to allocate capital to the best companies. And for them to do their good job properly, we wanted to incentivize them. But to incentivize people in the right way, to make them motivated, it's actually super complicated. And from hindsight, we know that the whole financial industry was actually very imbalanced and sick. Okay, so Finance 3.0. I don't want to give the impression that Finance 2.0 isn't still going on, because it is, and it's still a growing industry. But there are some first glimpses of new interesting stuff happening that actually is really using technology. And so that's why I'm here. You may have heard of some of these companies, so just some buzzwords. You have peer-to-peer lending, like Funding Circle. It's a very successful business in Europe where you can lend money to local businesses, and it's growing very, very fast. Cantox is a peer-to-peer FX exchange. TrustBuddy is a very, very successful Nordic peer-to-peer lending business. TransferWise allows you to transfer money abroad for much lower costs. And then in the bottom right there, you see Indiegogo, AngelList, Funders Club. It all has to do with kind of micro-funding. And these companies are all doing very well. Peer-to-peer is a bit of a buzzword. Actually, what really is happening is it's like simplification. They're doing exactly what a bank does. They take someone's money and they give it to someone else, and they take a small margin, but they just strip down all the unnecessary stuff so they can operate at much, much, much lower costs, and there are importantly also no hidden costs. So it's actually very similar to what happened to the airline industry like 20 years ago, or I don't know, 15 years ago, where you had low budget airlines. They started an airline from scratch. They didn't need all the stuff that you don't need to run an airline, and they were able to fly much cheaper. But what are these companies actually really trying to solve? So I'm going to go back to another famous JP Morgan quote, and he said, "No problem can be solved until it's reduced to some simple form." So what problem are we trying to solve here? So actually, I narrowed it down to two things. So we need protection from crooks. We don't want to give our money to someone who's going to run away with it. And we want to just make the best investment decision with the information that we have. But there are a couple of problems that make this extremely difficult. So at the top, I don't know if you can read it, information asymmetry. The person who is borrowing money, or the person who is fundraising, or the startup who is raising money, always knows more than the person investing. The second problem, adverse selection, is that the people who have the best business plan are the least likely to come to you to ask for money. The people who come to you are always the people that you actually don't want to give it to. And that's a huge problem if you're a marketplace like AngelList. Like, if you use a platform to raise money, maybe what's going on? Then there's the winner's curse, which is another problem. If a company is raising money and you end up investing in it, but they've been speaking to the whole world, that means that you are the winner, but that means that you were the one who was willing to pay more than anyone else. So we need to put systems in place to kind of avoid these hurdles. So how are these problems being solved at the moment? And what can we expect in the near future? So now I'm going to talk about technology investing, and I'm going to split it into two parts. So seed investing and growth investing. And seed investing is a company that has not raised money yet from any institution. Growth investing, a company that is raising money or already has raised money from a financial institution like a venture capital fund. So in seed stage capital, you have seen many new developments like Kickstarter and AngelList specifically. So how important are these? They play actually a really minor role so far. So here in this chart, you can see how are startups getting funded. So you hear a lot about crowdfunding, but actually, almost all the money comes from personal savings and credits. So that's the founder himself investing. And that actually makes sense because a startup has a really low probability of success. So only the founder himself is kind of deluded enough to want to invest in his own startup. Then friends and family, they kind of do it because they feel sorry for you probably. And there are only very few people that actually make a financial decision to invest in your startup. So what's going to happen with crowdfunding? Is that going to become bigger? It all depends if people are going to be able to make good returns on their investment in crowdfunding. So, and all those returns are going to be dependent, how good are these crowdfunding platforms? Are they able to solve information asymmetry problems that we discussed earlier? And you've probably seen in the press, there have been some weird projects on crowdfunding sites, and we need to wait a few years before we know if the average Joe, not an expert, but the average Joe can actually make money by putting his money on a crowdfunding platform instead of just putting it on a bank account or investing on the stock market. Yeah. Having said that, crowdfunding and also platforms like AngelList, they do solve one huge problem, and that is they make it possible to invest a very small amount in a startup. So if you have, let's say, $10,000 in savings, you can invest it in a lot of different startups. And then it starts actually to make sense. Because investing in a seed stage startup is like investing in a call option. You have a tiny, tiny chance of a huge payout, and your downside is no bigger than your investment. So why do I put the Google logo there? I just wanted to make one very simple point, that if you would have invested in 10,000 startups, and all of those 10,000 would have failed, except one, which turned out to be Google, then you would still have made a 30-time return on your investment. So, like this, it actually starts to make sense. By the way, there are some funds that operate completely on this strategy. So they basically just did statistical analysis and they decided if we invest enough in enough different startups, small enough amounts, we should be able to make a good return. And that's exactly what 500 Startups is doing in the US and what Kima Ventures is doing in Europe. I don't know if you've heard about Kima Ventures, but basically if you submit your business plan and you meet some basic criteria, there's a very good chance that they will invest in your company, and they invest within 2 weeks. Okay, so that's seed stage funding. Let's now talk about growth capital, which is more my area of expertise. Growth capital, with growth capital, I mean whenever a VC fund starts to invest in your company. Yeah. So the way it works right now is, okay, at the bottom, you see you have investment opportunities. These are companies. Then you have GPs, general partners. These are venture capital funds. They make the investment decisions. And where do these GPs get their money from? From LPs, limited partners. And these are asset managers, funds of funds, family offices, wealthy individuals. These are people that they do not have the expertise to see if a company is worth or not to invest in. So they give the responsibility of that to GPs. And to make these, in order to incentivize these GPs, they say, okay, I'm going to give you, let's say, 100 million, and just so you can pay an office and a secretary and have a nice office in the center of London, I'm going to pay 1% of this of the money I give you every year. And if you are successful, then I will pay you 20% of whatever money you make. So that's what they do to try to incentivize them. It makes sense. The only problem is the GP only has upside and no downside. And that's what we found out in the last 10, 20 years, is that overall the venture capital industry as a whole has underperformed massively, and they basically have made zero return after fees in aggregate. So the problem with this system is it's too expensive, and it doesn't reward. It doesn't properly incentivize GPs. So where is this model now going? And we're already seeing this happening. Instead of having such a segregation, you see more like one group where everyone's sharing the same information. So you have these asset managers, fund of funds, entrepreneurs, mentors, super angels, wealthy individuals investing directly in companies, but they still need someone's help to make a good investment decision. But instead of just blindly following venture capital funds, they search for successful lead investors. So they see people who are particularly successful in investing in a sub-segment within technology, and then they say, hey, this guy is on a roll, is doing really well right now. I want to invest where he is investing or where she is investing. And that's exactly what we are doing. So we are allowing, let's call it big money, to follow the successful investment behavior of lead investors, of experts. And the nice thing is, these lead investors, they put their money where their mouth is. So they have a huge downside if they make a wrong decision, because they have invested their own money. Yeah, so that's a big difference versus the old system. Now, one more quote from JP Morgan. He wrote, basically, I wouldn't give anyone my money unless I trust him. And I think, that's common sense. And the question is, do crowdfunding platforms solve this problem? And I think they're not solving it well enough at the moment. So we'll have to wait and see if in a couple of years people are actually making money by investing in crowdfunding platforms. I think that like a one-to-one relationship is still going to be always very important, because investing in a startup isn't like buying a house where you can search online. It's actually almost more like getting married. So you can do your research online, but before you actually write a check, you will want to meet the person you are investing in. So I have 1 minute left. And I'm going to use this 1 minute to briefly explain how Dealroom works. So historically, if you're a founder, if you're a startup, and you want to do a fundraising, you had two choices. You either do everything yourself, or you hire an advisor. If you do everything yourself, it's cheap, you save on fees. If you hire an advisor, you get some expertise, but it's extremely expensive, and you never know exactly what kind of expertise you are getting. I have been an advisor for 10 years, and I know that we always worked hard for our client, but it was always difficult for our client to see what we were actually doing. So now we deliver, through our own platform, all the benefits of an advisor, but without all the difficult terms. So you can hire us, but you only pay if we bring an investor. If you end up bringing your own investor in your company, you don't have to pay us. You can fire us at any time. And the nicest thing is you are in control. You have full transparency of how everything works. So we're really doing it together online. You can see which investors we're reaching out to, which ones are responding in real time. 10, 20 more seconds, if that's okay.
You can actually go on. And I'll also give you an opportunity if you want to engage in a Q&A, that'll be fine as well. I think this is quite interesting, so I'll give you that opportunity.
Okay,
brilliant.
Perfect. Thank you. So how does it work? We created a private workspace online. It's free to sign up. You upload and share KPIs. KPIs are basically, your performance figures. How is your company doing? Then we review those and we say, okay, we can work with you. You choose the best investors to work with. So you say, well, I'm looking for an investor who has an office in Kiev or who has invested in Ukraine before, or you say, no, I don't care about that. I just want someone who has experience in online travel, for example. You say what you are looking for, and then it automatically generates a list. Then we will, together with you, review that list and see if it makes sense. We will advise you on it, and then we have what we call a target investor list. Next, we send out an invitation. We monitor their interest. We monitor their response in real time. And let's say if you invite 40 funds, usually around 10 stick around and do more work on your company. And then we have a step-by-step process to work with us, our client, which is the company, and the VC fund, step-by-step from term sheet to completion. And by then, pretty sure that, that you get decent terms, because it has been a kind of competitive process. It's been tested by the market, so you know that you're getting a fair deal. Quickly on how we are doing. So far, we launched about a year ago. We have 1,137 funds, 244 super angels. Basically, this covers almost all active VC technology investors in Europe. We cover most geographies, all growth stages, from seed stage to mature companies. They have experience across all sectors. Any well-known VC fund that you can think of is our platform in one way or another. We have about 15,000 companies. The reason the number is not higher is because we set a limit. We only allow real companies that have traction and that have some proof of concept. We allow them on the platform. And again, across all industries, across Europe, Russia, Israel, Middle East, Africa, Latin America. We were skipping the US for the moment because it's still too big, but we will get there next year. Between investors and companies, this number is now outdated. There are 750,000 tracking connections. So every user can track another company, so they get all the alerts and updates if there's any activity with that company going on. And so between investors and companies, there are now 750,000 tracking connections. And we have so far done 14 fundraisings. The average used to be around 5 million, and now it's approaching 10 million. And that's it. That's where we are right now. And I just wanted to do one more quote from JP Morgan to end this presentation. Go as far as you can see, and when you get there, you'll be able to see further. And that's exactly what we're doing. Thank you very much. So,
can we get a microphone? Can we get a microphone out on the floor so people can...
So the question is, how is this platform going to change the returns for VCs? For LPs, for any investor. Okay. But I guess now you got the question. So it's a very good question. I think first of all, the problem that we're trying to solve is just to make the fundraising process less painful and more transparent, and also help companies save on fees. So I think with the liquidity that we have in our platform right now, I wouldn't brag that we're increasing anyone's returns yet, but there was a slide in the kind of halfway that showed, I don't know if we can, no, that showed there will be more skin in the game, and I think that will have a huge impact on investor returns. So as soon as the person who makes the investment decision has a downside in making the decision, that will affect returns. I really believe that. Like, it's basically the incentive structure of the whole financial sector has been just screwed up for the last 100 years. Where bankers and financiers and VCs have a lot of upside and not enough downside. Yeah, okay. Oh. Okay.
I think the downside is that reputation of a VC, right? So if you're not doing good investments, you're basically not going to raise your next fund.
Yes.
So are you going to solve that? You mentioned something about liquidity. Have you thought of solving that problem? Meaning, we were told that now it's about 11 years, like 10 to 11 years, the time frame of the fund.
Yeah.
The duration that your money is basically illiquid.
Yeah.
Have you been thinking about creating a marketplace for your investors, how they can get out of the investment earlier on?
Yeah, you mean like a secondary market? Yeah. There are people doing that, and I haven't thought about us doing that yet. So, but maybe, I don't know. I don't think so. However, so you saying, there is with the typical VC fund structure, yeah, there is like a 10-year lockup. So there's a 10-year delay. So a fund that has done very well in the beginning, then they raise another huge fund. And they hire a lot of people, they put them all in a big building, and suddenly they're actually not that good anymore. But it takes like 10 years for the LPs to figure that out. And I think if they do less commitments and more real-time investing, then this kind of feedback loop reduces from 10 years to 1 or 2 years. That makes the whole system more efficient and will perform better. Any other questions? Sorry? Whether our competitors? I think Angel is a competitor, although we focus much more on later stage. So you saw our average deal size has been 5 million, and I don't know what it is for Angel List, but I think it's 1 million or something dollars. So it's a big difference. Then I don't see any direct competitors, but I have a list of like 30 companies that do something with data. Data on startups is becoming a huge category. So you have Mattermark, Brightsun, many others that have good products in finding. Basically, they're improved versions of Crunchbase. And then you have marketplaces, and there are also a few out there. So you have kind of two categories. I think the problem with a marketplace or a crowdfunding platform or an angel list is that it has a tendency to attract the least desirable companies, because the really good companies, they don't need a platform, they're already funded. And the problem with using data to find the best companies, like MetaMark is a product that allows you to, to see, okay, which company is the fastest growing right now. Problem is that if everyone uses the same tool, that data becomes less and less valuable. So we use crowdsourced data coming directly from founders. And these founders, if you're a strongly performing company, you have an incentive to share your data with the best funds to get the best terms.
All right, great.
Yeah.
Well, let's hear it for Yoram.
Okay.
Thank you very much.